So for this session, we have with us Michael Collins, who is a partner and managing principal of Equinova Capital Partners in Chicago here. Equinova provides merger and acquisition advisory services and private equity capital to middle market companies. Michael has focused on the building products industry since 2006. He publishes a monthly newsletter highlighting trends in the building products industry, and he writes a column for Door and Window Market magazine, so you've probably seen that in that publication. That column covers trends in the door and window industry. So today, Michael's going to provide an overview of the fenestration and glazing industry against the backdrop of the larger building products industry and the macroeconomic environment. He'll address how the post-COVID economy and inflation, not eflation, are affecting business valuations and the merger and acquisition environment. He'll also cover the outlook for the building products industry, construction, and remodeling, as well as relevant trends. I think I'm sleepy still too. Trends affecting our market segment. So thanks so much, Michael, for being here, and let's please welcome him.
Well, thank you so much, everybody. Good morning, and thank you for choosing our beautiful city of Chicago for this meeting. Not only convenient for me, but a great spot for a meeting, and you're here at the perfect time of year. There are really only two seasons in Chicago. They are winter and construction. So this is that magic time of the year when winter hasn't started yet and construction is maybe easing a little bit. So I don't know how many times I've spoken at what was originally AMA and now FGIA meetings. It's a lot. But I do know that this is the first live presentation, live audience speech that I've given since before the pandemic. So a big milestone and certainly a glad and welcome event for all of us to be back in person. It's good to see some familiar faces. So I have a lot of things to cover this morning, so we'll just go ahead and jump right into them. I want to make sure, okay, that's the slide on the left that I can see. Okay, so whenever I give a presentation to a group that I've spoken to before, I like to look and see what did I say the last time I was there. And that way, you know, if I've made any wild predictions that turned out not to be correct, I can think of something to blame that on. So there were none last time, but I did want to give just kind of an overview. The last FGIA presentation that I gave was virtual. It was in May of 20 when we were sort of in the peak of the COVID period of figuring it all out. And just to give you an amazing kind of summary of what I covered the last time, how different things are now. In the last time I spoke at one of these meetings virtually, 30 million Americans had lost their job in the previous 2 months. The stock market had lost a quarter of its value. The GDP, which was on track that year to grow 3%, was immediately, the projection was reversed to a negative 3% virtually overnight. We take the vaccine for granted now. The advent of a vaccine was by no means certain at that point. It was sort of just beginning to be understood and possibly start to work on it. And more germane to our industry segment, there was a very big difference state by state as to which rules and so forth were applying to construction, which states viewed construction as an essential activity, and that really was determining sort of the haves and have-nots in the building products industry of who could operate and who couldn't for that period of time. So highly welcome to have all of that behind us as we look at the economy today. Now, despite the fact that things are going very well, I got a chance to catch up with a couple folks beforehand. Just added two or three companies to the list of companies I've talked to that are doing just very well right now. The economy is continuing to do well, although we're starting to see the cracks of recession and the possibility of recession. And I do believe in maybe part of the non-academic part of me that we can worry ourselves into a recession in this country because we get hearing so much about it, and all of a sudden it's, should I take on that new venture? Should I do that new thing? Maybe I'll tap the brakes. Let's wait and see. And those three words, wait and see, end up making a recession, in my opinion, at least in part, a self-fulfilling prophecy. So if you look at the economy from the 1960s to the last sort of bubble period, 3.4% is kind of a normal economic growth rate. We had in 2020, we lost that amount. The prediction turned out to be correct, and plus a little. We had growth again in 2021 as things, started to get a little bit back to normal, 5.7%. And this year we've grown not, a couple of percent, not anything too great, with next year looking to be kind of a flat year, okay? But if you think about past recessions and the way they felt and the way this current economic period feels, everybody's so busy, it's sort of like, well, we've slowed down a little bit, but that let us burn through some backlog and things aren't as crazy, and we got to let the factory folks take Saturdays off again, and a lot of these companies have been just running full out, and that's not necessarily a good thing for employees or for anybody. So to see a little bit of slowness, I think we're so accustomed to the growth that the kind of slowness we might see, we might have a technical recession where the economists draw a line on the map and in the chart and say, yep, this was officially a recession, but I don't think it's going to feel like a lot of past recessions have. Now this slide about inflation was kind of tricky to name because it started out with the consensus at the time that maybe inflation had peaked. Then as I was working on different revisions of this presentation, it became clear that we felt inflation hadn't peaked and the Fed has raised interest rates again since then. So I think I sort of have double hedged here that we may be nearing our peak of inflation, because certainly in August it was still at 8.3% in the US. In the projected period, it's expected to average about 3.4%, which is an easy arithmetic, double the longer term average rate for inflation. So certainly not what we want. But the Fed has been, pretty aggressive this year about raising interest rates. That'll have some implications for the industry that we'll talk about in some of the further slides in the presentation. But the one thing raising interest rates does do is tamp down on inflation, because everything, borrowing and operating, everything becomes more expensive when interest rates go up. So taking a look at the employment recovery that we saw since COVID, and we'll zoom in on the more recent period in the next slide, but I find it interesting just for perspective to see how bad did it really get? How bad did the unemployment picture really get at the height of COVID? And you can see that unemployment stood at 14.7%. And certainly that is as high as it has been in decades, if ever. I don't think it's ever had been that high. The worst of the Great Recession was an even 10%. That was the peak year, October of 2009. The recession in 92, unemployment peaked at 7.8%. What I consider to be my first recession that I remember in 81 and 82, not that I was in business at the time, I was, 9 years old. I just know that growing up in Michigan in 81 and 82, everybody was unemployed and nobody had any money. So that's my first recession that I remember. The recession is 9%. The fact is, all of these unemployment levels paled in comparison to the level that we got to with COVID. And so then you look at 14.7%, and the special programs ran out, the stay-at-home don't work kind of money ran out, and so people started to go back to work. They got the vaccine, that encouraged a lot more people to go back to work, and we've come down to 3.7% unemployment levels in this country. That's essentially full employment. And I'm going to talk a little more in a bit about what that means, but for this country, it is the strongest employment recovery that we've ever witnessed. Now, I am by no means an expert on the Canadian economy. I certainly wouldn't call myself an economist in terms of even of the U.S. economy, but we know that we have some FGIA members that are Canadian companies, so we wanted to sort of take a holistic look at least Canada and the United States. And looking at Canada, obviously every country in the world essentially experienced COVID in its own way. Canada's pattern not much different than the United States, but their economic activity got back to pre-pandemic levels, which is kind of a key milestone when you've had an external shock to an economy, is when did we get back to the last previous normal? November of 21, so last year. But then this year, it dipped back below that level in Canada. Economic activity dipped back down, so it's softened a little bit. The chart at the bottom talks about inflation. And they have had, the Canadian economy Canadian banks and Canadian companies tend to do things in a little bit more conservative way than the US, in a good way. So then in the housing crisis of 08, 09, Canada had a similar housing softness, but nothing like we had because they didn't have the speculative mortgages we had. They just tend to do things in a little bit more conservative manner. Now, maybe that means they don't enjoy the run-up of bubbles, but then they don't have the burst that we sometimes have in this country. So Canada has had some inflation. Current inflation rate in Canada is about 7.6%. Essentially, if you have inflation in the U.S., because there's so much cross-border trade between the U.S. and Canada, Canada really can't exist in a vacuum separate from the U.S. in terms of inflation because it's too easy for us to go over and buy goods from Canadian companies. And if they were somehow cheaper over there, American companies would theoretically buy those goods until the price had come up to match the U.S. price. So really, Canada really can't do anything to insulate itself from inflation. If the U.S. has strong inflation, Canada will have inflation and will have to do the same kind of things that we do in the U.S. to combat that level of inflation. So what has Canada done since the beginning of the year? They've raised interest rates 3%. We were at 2.25%, which was interesting that Canada had actually raised rates more than the U.S. And just last week, we raised rates again 0.75 point. So we're now at 3%, and Canada has raised their rates 3%. Again, not an accident. There's so much cross-border finance activity as well that if somehow money was cheaper in Canada or the U.S. relative to the other, the major companies and banks in that other economy that spread would go away because they would begin to use borrowing from the other nation instead of their own. So they're very tied together. Those two economies are tied together. Now, interestingly, unemployment in Canada, sorry, it's hard to see that peak point there on the spike of the graph. The worst unemployment got in Canada was 9.5% during the peak of COVID, and currently Canada is at 5.4%. Now, I can't comment as to whether that's a full employment level of employment in Canada the way I am aware that 3% is in the U.S. I would suspect that it's not. It seems too high to be full employment to me. And the reason full employment isn't 0% unemployment is that there's always some frictional unemployment in an economy. One spouse gets a job in another state, so the other spouse resigns and moves, and now in that state they're an unemployed person until they find another job. That kind of thing. There's always that frictional job changing kind of unemployment, but I suspect in Canada they are not at full employment right now. Now in the United States, as I said, we sort of worry ourselves about these recessions as if they last for years and years, but the fact of the matter is they typically only last for months. It's going all the way back to 1857, we've had 34 recessions in this country. Now, the shortest one, interestingly, was the COVID recession, which was a hard spike downward and then a sharp recovery in mid-year as things came back. February to April was technically the recession period during the beginning of COVID. The longest recession we've ever had was in the late 1800s, lasted 5 years. So if you look at that same 1857 to the current period, they last on average 17 months. Well, that's coming on a year and a half. But importantly, as we've gotten better at, frankly, measuring our economy, responding to changes in the economy, the Federal Reserve didn't exist in the 1800s. So all these tools that we have at our disposal now, the recessions that we've had, 6 of them since 1980, have only lasted 10 months apiece. So the government learned the lesson the hard way in the Great Depression when the economy got soft and everybody said, oh, gee, we can't be loaning money out. These businesses are going bad. We better pull in the reins and stop loaning money. And that drove even more companies into bankruptcy and made that a depression instead of a recession. Well, the reason the last recession didn't become a depression is that the government just flooded money into the economy. And every time there's a negative external shock in our economy, the government opens the spigot and floods liquidity into the economy, and then that helps our economy. So if we've learned one lesson in all these years, that's the lesson we've learned. And in my opinion, that has resulted in shaving 7 months off of the average recession and trimming it down to just 10 months. So then the question comes up, okay, well then, if we have a recession, but it doesn't feel like a recession and we're all still busy and everybody's still selling a lot of products, what do you do about a recession that doesn't feel too much like a recession? A lot of companies have a lot of liquidity right now. They have great strong balance sheets, debt's paid down, profits are high, there's still backlogs, there's still this tremendous housing shortage in this country of a backlog of a couple million homes that weren't built that need to be built. So you start to say, well, what could we do? So in the past, and I honestly don't even know if this current soft patch or recession will last long enough for the government to have time to implement any of these, but in the previous recession, the Great Recession, 08, 09, 10, one of the things the government did, and many of your companies probably took advantage of it, was accelerated depreciation on machinery and equipment. And the companies were able to expense the cost of that equipment. It saved them a lot of money in taxes. Instead of having to depreciate that over a number of years, they could take the expense right away. So it was an immediate tax benefit. And there were companies, frankly, that went out and bought equipment that they did not need at the moment, state-of-the-art equipment. Doesn't really matter if you need it just that second, because then when the economy did recover, those folks had excess capacity to meet demand, and they were the biggest long-term winners from the trough period of the economy to the recovery. They really performed the best, companies that did that. Another thing to do is take a look at hiring key sales professionals from other organizations. We've had companies refer to that as an acqui-hire. So it's not an acquisition where they bought a company, but they did an acqui-hire where they threw some money at recruiting a top hot salesperson. And sometimes that person can bring a big chunk of business with them, and it wouldn't feel like you bought a whole company, but it would sure be a definite boost. Other thing is to explore new geographies, new products, and I think it was Alan Greenspan that used the phrase about our economy, that we had a Goldilocks economy. It wasn't too hot, it wasn't too cold, it was just right. And I've seen over time in the building products industry that the same kind of thing happens, where we need a Goldilocks environment in this industry for us to be willing to try new things, to come out with new products, to develop new things. If everybody is just running like crazy and busy and selling as much as they can possibly make, that's not the right time to catch that person with a new idea, with a new acquisition, nor is it the right time when they're starting to tighten their belt, maybe they're laying people off, things are too slow, nobody wants to do it then. Things have to be kind of just about right. And when we've had things as hot and as strong as we have the last 18 months, and now maybe there's a general soft patch for the economy that lets us all breathe and catch our breath, maybe that makes this one of those Goldilocks times that companies in our industry segment can explore new ideas and new products more than they did in the past. Now we'll take a look at the construction and remodeling outlook, always of interest, but I always, want to stress that a given area that you focus on can shrink, and if you're nimble and outcompete your competitors, you don't necessarily feel that dip. So there's always that possibility of doing well in a tough market environment. I do want to stress that. In 2020, when COVID first started, and I found myself glued to the daily update every day, what is this thing and how bad is it going to get, and oh no, here we go again. If you had described to me all the things that were going to happen in COVID, and then said to me, but don't worry, the building products industry is just going to go gangbusters, great, I would have thought you were crazy. But we all know that's exactly what's happened. In 2020, housing was stronger as people were in sort of a flight from multifamily to single family. They wanted that home, they wanted that space, they wanted to be out away from other people, benefited there. The trend continued in 2021 as housing was continued to be very strong. This year, I'll be honest with you, when I saw these NAHB numbers, that the market had come down quite that much this year, 13%. I was really surprised by that number, because everybody we're talking to is just running as strong and as big a backlog as they've had in years. So I was surprised by that. We could have another soft patch next year with an additional 8% NAHB's projecting of decrease in new home construction. But again, I think it's going to be the kind of year that for the people in the industry that are out there getting after it, it's not going to feel like, oh, we've had 2 malaise years in a row like it did in the old days. And when I did one of these presentations, I struggled to have something sort of positive or hopeful to say in it. I think it's going to still feel like it feels right now, which is pretty strong and pretty busy. And then, 2024, their crystal ball tells them we could be up strong again and get up over 1 million homes and sort of back to where we were a couple of years ago. So, you could glass half full, glass half empty, but definitely, a lot of opportunities in a market, even when there's a top line shrinkage in the number of homes built. Same thing with multifamily. Multifamily is that classic kind of variable item that some years does better than others. This year has been a great year for multifamily. As maybe, again, vaccines, people are calmed down, interest rates have come up, lumber prices were up, so homes were expensive to build. You're seeing a lot of, you know what, we'll get an apartment for a couple of years and we'll see where things stand in a couple of years. We don't want to buy a home that we're getting less home for the money because lumber's up. You know, I just saw in the news thing this morning that lumber's down now, record low in the last 18 months, 2 years. So things are getting back to normal, and now interest rates are up. So we'll talk about that, the impact that has. But the point is, multifamily is a segment that's you know, going to continue to do well. Residential remodeling, classic growth at a slower rate. You know, we're so spoiled by strong growth that when we see slower growth, we tend to grumble. But residential remodeling right now, you know, this year will grow 7%, projected to grow 6% and then 4% the next 2 years. We're talking to a lot of companies that make different window and door products that are telling us, well, you know, we're definitely seeing our builders, you know, pause for breath or take stock of things. You know, nobody's talking about builders shutting down or dumping real estate or any of the things that you saw in the downturn. You know, they're sort of pausing for breath after really strong runs. But homeowners that have made the decision to stay put are now throwing money at remodeling, and in, you know, whether it's overhead doors or it's windows and doors, they're willing to pay a lot of money to have things just the way they want. And when they know they're going to stay put and it's a longer term investment for them, they're paying up. And I'm confident that's what's driving a lot of these remodeling numbers. Is, you know, you've got a lot of folks out there that have high 2%, low 3% mortgages. Well, they're not going to go buy a new home right now because they're looking at a higher interest rate environment. So if we're going to stay put, and if we just got out of a few years where we didn't travel as much as we used to and take big vacations the way we used to and so forth, and we've got some money, and personal savings is certainly immensely higher than it was before the recession, or before COVID rather, what are you going to do with that money? You know, you start to get ideas for your home, and they tend to be higher end ideas. Now, some of the other trends affecting the fenestration industry, let's just go ahead and start there. I don't need to tell anybody here we've had a lot of supply chain challenges in this industry. About a third of the building products in this country are produced in China and then brought over here. That's always been a tough supply chain to manage. It got even tougher in COVID. And we're in touch with different market segments where there were little widgets, you know, in the overhead door industry, there's a little widget that goes into a door that sort of stops the door from falling too far and so forth. It's a little piece of metal. They're like 75 cents a piece before COVID. And they just were sort of everywhere. Everybody sold those. If you sold any overhead door parts, you sold those. Nobody thought twice about getting those. And then some days somebody'd call and, hey, do you have it? No, I'm out of those. And the next company, no, it's funny, we're out of those. The next company, all of a sudden it's sort of, everybody's out of these things. Well, now they're $1, $2, $3, $4, now they're $5 a piece. They used to be 75 cents, but you have to have them, so no problem, we'll buy them. Well, then nobody had them. Well, then it all kind of came together that there were only 2 manufacturers of that little thing in the whole world, and they were both in China, and both their plants were mostly shut down because of COVID. And so this product that we all take for granted, and none of the people don't even know what it is, couldn't even go point it in their garage. The point is, everybody in the industry took it for granted, and all of a sudden you couldn't get them. And that's the kind of thing that we're seeing where, you know, those are products that maybe could be reshored and brought back to be manufactured in the U.S. because they'd never cost that much in the first place. The cost differential wouldn't be that much in the U.S. And there's things like that being considered right now of, is this mission critical, inexpensive product really worth manufacturing in China, or should we start buying this domestically? So supply chains have gotten a little bit better, but they're still not back to normal, and we're seeing people make those kind of choices about where to supply things. Still, everybody we talk to is having a hard time with labor. That 3.7% unemployment, as I mentioned, that's the full employment economy, full employment level in this country. You can't get much lower than that. And what happens at that level is that everybody that wants a job has one, and you're out recruiting against people's inclination not to have a job, and so you're sort of competing with job, no job, you know, whatever that choice looks like for folks, you're luring them away from that to get them to work, and that's not your top performing people that you're getting in at that time. So employers are having to hire 10 spots to fill 2, 10 spots to fill 4. And that's really what's going on. And it's getting better, and it's better than it was 6 months ago, but hiring is still very difficult. And one thing I'll throw out there that a number of the companies that we talk to have had really good luck with are sort of part-time or full-time human resources people that maybe are retired, or it's somebody that has a child care situation that causes them to want to work part-time or whatever, but they want to keep doing something. They'll bring those folks in, great experience, great ability to talk to people and bring in hires and convert hires to employees, and they'll have them become kind of an in-house recruiter for what are essentially blue-collar positions. And that's not something that companies did in the past, but more of them are starting to do that now, and they're having good success with it. It's sort of a dedicated effort of pushing out on not just job sites and different social media, posting things, posting with community organizations, whatever they can do to bring in enough people to satisfy what they need in the plant. Now, another kind of high-level trend that's certainly going to have a huge impact on this industry the next 10 years, global warming. Deloitte came out with a report recently that they felt that global warming is going to cost our global economy $180 trillion over the next 50 years. And I have to confess, when I saw that, it kind of reminded me of the meme, if anybody has seen it, of the astronauts doing a spacewalk, floating out in space, and as he looks back at Earth, an asteroid is hitting Earth as he looks, and he says, "Oh no, the economy." So I think sometimes we do get a little bit too focused on the economy. I'm as guilty of it as anybody. But where you make people care about a thing like global warming is the economic impact of it. So they're saying it's going to be enormous. Window and door thermal performance is right at the crossroads of that need and that trend to help in that aspect. There's few products that could do more to help address that. Energy Star program's been out for many years, has an excellent reputation, again, in the industry. The standards are coming out. Energy Star standards are, did that do anything? Oh, sorry. I'm not going to be the one to talk about the specifics of that. I understand there's another presentation later today where you'll learn much more than I could share with you about that. But as a semi-outside observer, meaning I'm in this industry and I work with companies in this industry, but I'm never the person that has to make any changes to satisfy the Energy Star requirements. What I observe over time is the standards come out. They're always stricter. They're never looser. They'll never be looser. They're always going to be tougher to meet. No one ever says, "Oh, that'll be a piece of cake. Oh, that'll be easy to hit that." It's always tough. There's always concern, consternation at first. And then the folks in this room and the people, your colleagues at your companies, find a way. And it's one of the things I love about the building products industry. COVID, there were so many crazy things that happened. Everybody found a way to make it work, to get products out the door. They find a way, and the industry ends up better, products end up more efficient, and in the long run, the ever-tightening, toughening standards of these programs are a huge benefit to our economy and helping address something as serious as global warming. And frankly, there's a lot of money to be made from coming up with products that provide and a helpful solution, not a solution, but a contributive factor to that. Increased outdoor space. I have a tendency to pay extra special attention to trends and things that I see private equity funds doing where they're betting with their money on things that it would be easy for someone to say, outdoor space is really, people are really focused on outdoor space right now, and then it turns out that person sells products for the outdoor space. So, you sort of think they might have a little bit of a biased opinion. But when you've got a private equity fund that could invest in anything they want to in this country, and they go out and they raise and they commit capital to making investments in rolling up products for the outdoor space, whether it's landscaping, hardscaping, things like that. And there are several groups right now that are engaged in doing this. When you have that kind of smart money chasing a segment, that's a segment that's got a 10-year demographic groundswell behind it that's going to benefit that segment. And we're in that position right now. Now, why do we care about that in the fenestration industry? Because we are that interface between outside space and inside space. And the better you get the outside space looking, the better that interface needs to work and be. And bigger doors, bigger moving sliding door systems, bigger wall systems, things like that, more energy efficient. On the global warming point, there was some discussion a number of years ago about limiting the percentage of a wall that could be consist of windows or glass. The more efficient our products are, the less ideas like that, which we in this room think of as a terrible idea. If this was a drywall convention, maybe we'd love that idea. But we think that's a terrible idea to limit the size of windows and doors. The more energy efficient they are, the less likely anybody is to mandate restricting the size and type of use that they can contribute. I always like to comment on the distribution channel because it's a key aspect of operating in a given environment that I think gets overlooked. This is lumber yards, home centers. These are companies that distribute the types of products on the residential side, at least, that the folks in this room sell. The blue pins are companies that work, so that would indicate a shrinkage of the width of the supply channel, because effectively now those locations, those 97 locations, are owned by distributors that already were in the segment. So you would assume pricing would be uniform, availability of products would become more uniform, meaning there's fewer buyers when there are acquisitions, 97 of them. That doesn't look anything like 97 pins, but I did confirm it. Some of those pins represent locations. They're just so close together in a given area that you can't discern them. So they're just covered by one pin. Only 28 locations were greenfielded. So on some level, we have to look at the difference between the number of acquired locations and the number of greenfield locations as a measure of the narrowing of that distribution channel that stands between all of you and John and Mary homeowner. So that's a key thing to keep in mind. It puts emphasis on making sure you're getting out there always seeking new customers, because you could end up losing a customer simply by having them acquired by another chain. They'd love you and mourn the loss of the business relationship, but they could be forced to work through another channel because of an acquisition. Infrastructure spending. McKinsey is a consulting firm. They estimate that it's going to take probably $150 billion a year all the way through 2030 just to keep up with our infrastructure spending in this country. And that's lagging infrastructure spending, meaning break fix. This bridge is looking, dilapidated. We've had some tragic bridge collapses in this country. It draws a lot of attention to, hey, we better start testing bridges and start, taking better care of our roads. Let's throw some money at that. Maybe someday in the future we'll get to the point where infrastructure is leading growth and we're building out infrastructure to lure growth to a given area. Right now we're trying to maintain growth by keeping infrastructure strong. And in this room, we're not, asphalt companies and concrete companies, and we don't manufacture guardrails for highways and things like that. Those types of things, and airports, all the other electrical things that represent infrastructure, those types of companies will certainly benefit first, no question about that. But when you have infrastructure improved in a given area, the better the roads are. Oh, now that they put that bridge in, now that's a short commute between those two communities. I bet that community will become a feeder for this community. And so, builders make a decision of where to locate subdivisions. Office buildings make decisions based on the infrastructure. All those kinds of decisions depend on the transportation and other infrastructure in a given area. So we would benefit in a secondary wave from every bit of that infrastructure spending in our industry segment. Now, one of the things that we track are window and door plant expansions. Any manufacturer of a window or door product in the U.S., if they have a plant expansion, we record that. Now, in the downturn, we were recording plant closures because they were business driven. There then got to where, it would sort of be not a closure as much as a rationalization. We've got 3 plants. We're going to combine the weakest of the 3 or the oldest of the 3 into one of the others. That didn't really feel like interesting news to share, so we felt like we'd stop paying attention to plant closures until they get to be a meaningful signal. But right now, it is interesting that you've got in 21 and 22 a lot of money being committed by window and door manufacturers to expand plants, with 27 plant expansions that occurred those 2 years. So that's, for anybody in the room that deals in manufacturing equipment, that's obviously welcome news in the short term. But for the companies undertaking those expansions, that lets you trim down backlogs. It lets you compete more nimbly. It's just a benefit and a positive in every possible way to see those plant expansions come back. So that was welcome news. And you can see from 16 to 20, it was just a downward, slide. Gee, when's somebody going to invest again in window and door plants? It's happening. Now, the state of the M&A environment, that's obviously what I do for a living, sell companies. we'll take a look at M&A activity. This is global M&A activity, the whole world. And you can see the top bar is 2022, the next bar after it is 2021. You can see this huge amount of activity in 2021, somewhat less this year in 2022, but considering how strong 21 was, and everybody expected sort of maybe a little bit of a vacuum coming behind that, it really has continued to be a very strong year. Now, 21 benefited from what we would call a rush to the door, because people were convinced, and we made 100 decisions that year based on being absolutely convinced that capital gains taxes were going to increase for 2021, and that the government had put certain milestones in place that would let them reach all the way back into the middle of last year. So we were hustling to get deals done, and so a lot of them got done. In 2022, it's still been brisk this year. Activity's been strong, even though the consensus is that with midterms and all the other things going on, the government is not likely to get their hands around raising capital gains taxes for 2022. So there hasn't been that hanging over everybody's head, but activity has still been very strong. Now, most of the time when you buy a company, that acquisition requires the buyer to utilize some amount of debt capital. Debt provided by banks at an interest rate, and interest rates have gone up. Any good that you can name, any normal good, luxury goods like perfume and things like that, demand can actually go up when prices increase. But any normal economic good, when the price goes up, demand will drop. So if I'm a company buying another company and interest rates have gone up, I have to factor that into my success case on making this acquisition. And I can need the whole return to still be what it is. So if I'm paying more in interest, maybe I'll bid a little bit less. Same thing with homeowners. Interest rates are higher. We've seen homeowners slide a little bit down the scale of the home prices and sizes that they're looking to buy right now in this market in response to the interest rate increases. Now, historically, interest rates are still at a very attractive point, and I'm sure some of you in this room bought your first home at an interest rate that if we knew that interest rate, we might think you bought that home on a credit card, because rates used to be so high in the past that was astronomical. Now they're still at a relative low, but it will affect M&A in the next 2 years. So where does that fall with window and door manufacturers? We track M&A activity among window and door manufacturers. The activity has to be one of the two companies has to be a U.S.-based company. So there have been some deals this year where one Canadian company bought another Canadian company. We don't happen to track that in our database. Or if it has to be one U.S. company at least. So if you look at that activity, again, it peaked in the run-up to the last bubble period, and it's kind of drifted downward over the years. It's had some jumps lately. Part of that, frankly, is that once you've had a run of acquisitions, there aren't as many companies out there to acquire. And although in every industry, and windows and doors is no different, there are new companies that are formed that would then hopefully grow and become that next sort of big company. But those, some of those companies haven't gotten big enough yet to show up on the radar of the companies that are out making these acquisitions. But they would be the companies that would be acquired in the future. Although there are fewer, small private companies each year as the bigger companies acquire them. Now, for some of you, this might get a little far into the weeds, so I apologize if this isn't of interest, but I thought you might find it interesting to just sort of know mechanically, how does the idea of, COVID, a lot of buyers are using the phrase COVID bounce or COVID bump, and that refers to the benefit that building products companies got from the COVID period, sort of unexpected. At different times, it started out with superficial things like paint and products like that. Then as people realized their home office was too wide open for there to be kids getting homeschooled in the next room, they needed to put a little more division in there. Now you're selling drywall and wall studs and things like that. So it kind of evolved in waves over time. But the point is, some companies had a benefit from COVID that buyers wonder, is that temporary? And so then how does that come into effect? How does that really, where does the rubber hit the road on that? So this is a fictional company, although its metrics are similar to what real companies could be. $40 million in sales, nice round number. $30 million in cost of goods sold, so all the material, the labor, the overhead, all the products, the physical things they buy, and all the labor to turn them into their finished good, $30 million. So their gross profit that even has a chance to get down to the bottom line is $10 million. It's gross profit margin 25%. Operating expenses, which is, your selling, administrative, office, all the different things, $4.5 million. It's another 11% of sales for an operating income of $5.5 million. Some other expense or income, which would be, could be gain or loss on sale of assets. It's things that are not core to the business. Point is, this business is doing $5 million in net income on $40 million in sales. Well, then we say to ourselves, okay, well, what is the EBITDA of that business, which is the earnings before some of those factors we just took out, interest, taxes, depreciation, amortization, essentially the cash flow of the company, okay, cash flow of the business. So we add back our depreciation and amortization, and we add back our interest. And we end up with EBITDA just shy of $5.5 million, an EBITDA margin of 13.7%. So what that means is that this business goes out, sells $40 million worth of product, and 13.7 cents per dollar is available to that company as cash flow to invest in their business, expand, do whatever. So if I'm a buyer, all these numbers are interesting, but the one that is most going to input and impact my valuation is that EBITDA number, the cash flow of the business. And so if I'm a skeptical buyer and I think that this business had an artificial COVID bump, I look at that EBITDA number and I say, well, is it sustainable? Can they keep that going? Or did they, some businesses had such an obvious glaring COVID bump that so quickly went away, like masks or hand sanitizer or things like that, I'm sure sales skyrocketed and then they fell off sharply after the vaccine. Building products companies aren't like that. There's still this steady demand, and we're finding that a lot of the companies continue to have strong demand into 22. So it is sustainable, if you see what I mean. But that's where the argument would take place, so to speak, or the negotiation. So then the upper column on the right says, okay, now we've got this $5.5 million EBITDA. I've just picked 6 times as a relatively arbitrary EBITDA multiple, meaning they're paying 6 times cash flow for the business. A given company could get more, could get less. It's not meant to signal that that's what I think the market's at. It's just a reasonable number. So the value of the business would be about $33 million. Take out the debt, $4.6 million. So the person selling this company would hope to get pre-tax $28.2 million. So COVID comes in and says, is there a bump? So now you're arguing about the EBITDA number. Inflation comes in and a buyer says, well, how many price increases did you get from your component manufacturers last year? 7, and then you look at them and boy, they really add up to a pretty big number, but that's not the right way to do the arithmetic. You don't add them up, you multiply them by each other, because when the first one was 10% and then the next one was 7%, well, the 7% needs to apply to the 10% too. So some of those figures, when you multiply those all the way out over the course of the year, they might represent a 70 or 80% increase in that component. And so then you get into the discussion of, are your prices going to have to come down? Is that where inflation is going to be a problem? And so you then get into these discussions, but this is the mechanics of how those discussions happen. And so a business is trying to say, no, we are sustainable, our earnings are sustainable. So they start to look at what are the factors and the ways to show that your earnings are sustainable, okay? So strong inflation, we talked about that. Revenue growth, is it a bump? Talk about that. So you start to focus on this list of factors at the bottom. Okay, well, did we, during the last 2 years, grab additional market share from our existing customers? Meaning they told us, hey, you're so much better than XYZ, I'm gonna buy from you now, and I've stopped buying from them, you're doing a great job, you've got our business. And now you're a bigger share, so as that customer grows, that will benefit you more than it would have benefited you 2 years ago. Did you add new customers during the pandemic? That was tough, because a lot of times it was people that were desperate for product, you'd love to have served them, but your lead times were so long with your existing customers that it brings us to this next factor, which is how many customers were interested in our product, and did we have to turn away during the downturn? And if you are in a position where you have to make the case for your company, not even that the company's being sold, but you're looking for a bank loan, or you're doing any, explaining even to the owners of the company, if they're non-active owners, they might not understand fully the dynamics of what made the value or performance of the company move during the year. So you could focus on these things as well, and to know, starting point is know your component price increases. How much did those go up during the year? Know it as where you're at on that. And then to do these metrics of how many customers did you add, how much market share did you grab, and then how many customers did you turn away that are sitting there waiting to be reapproached now that you have more bandwidth and more ability to serve them. That's where the future growth of the company can come from. So those are some kind of key factors in that to keep in mind. Hopefully not too far into the numbers there. You will be given a copy of the presentation if anybody wants to study that income statement later. And if you have any follow-up questions, certainly feel free to reach out, and I'm happy to answer any of them as to what that really meant. But the point is, if we step back and just look at the industry at a high level, we continue to be right in the middle of the path for tremendous changes that are happening in the economy and happening around the world that we in this industry can help and benefit from, and people can benefit from the products of the fenestration industry. So we're right where we want to be in terms of that. We have the possibility of a short-term recession. I do think it will be very short-term. I think it will be one of those recessions that's, by the time the economists are officially saying we're in it, we'll be more than halfway out of it. And then a couple of quarters later, it'll be sort of that's done and let's all, get back to a more normal situation. But the fact is the industry is in a great spot and, really very optimistic for the outlook for the next few years. So with that, I will give time for a couple questions. Okay, yeah. And I think they have microphones set up if anybody's not shy, or you can shout it out. Any questions at all? No? Okay, well that's because they told you to shut your cell phones off at the beginning of the meeting, so there was no fact checking that could take place. I know there's a bunch of engineers lurking around this room and there will be fact checking otherwise, so hey, good morning.
Hey, Michael.
Hey,
nice presentation as always.
Thanks.
A good job. Just one question. I was wondering on the comment about we may be at the peak of the inflation right now. I mean, as I look at all the money the government's dumping into the market, we've got about $8 trillion here over the last 2 years between the 4 different acts that have been passed coming in, and that's like over the next 5 to 10 years. So why wouldn't that inflation continue for that period of time with that much money coming in?
So it's a good question, and inflation in this country is not just like GDP growth, other than COVID, where it did sort of a breakneck change from positive to negative. Inflation doesn't happen overnight in this country, and it doesn't go away overnight. And I am concerned when I see things like the Inflation Reduction Act that includes more spending, which is a little bit like a runaway fire act that includes throwing kerosene on the fire, but there is some spending in that bill and it would contribute to that. I would say to you only that the Federal Reserve will raise interest rates until businesses are yelping so loud that there's no question things will slow down and you'll have inflation subside. So that is their number one aspect of the economy that they target. And interest rates are like a blunt instrument lever that lets them calm things down enough to have inflation go down. So unfortunately, no matter how high they have to get interest rates up, they will raise them until the inflation subsides. That's the unfortunate fact of the matter. And so that means there are probably more interest rate raises in sight. So a good question though. Yes, sir.
Yeah, good morning.
Morning.
Just to make sure that I understood this slide on mergers and acquisitions correctly, when the number of total M&A shrinks or grows, is that an indicator on our industry health as a whole?
So I want to make sure I understood the question. Is it that when M&A activity in the window and door industry goes down?
Goes up or goes down?
Goes up or goes down?
Is that a direct
Yes,
indicator
so
on our industry health?
So it would be, if you look at it, I forgot to mention this, but in all this time period, 22 years we've been tracking this number, 22 years of data rather, almost without fail, 75% of the buyers are strategic buyers, and 25% of the buyers are private equity buyers. The strategic buyers tend to buy sort of steadily whenever an opportunity comes up to acquire a company that's a complementary fit for them. If financing is available, if they can, they will buy. The private equity buyers that are that additional 25% of activity, they are fickle. And if you look back at this chart, 04, 05, they couldn't get enough window and door manufacturers. They just loaded up. And then as soon as the market softened, they fell off, the acquisitions fell off, and they stopped buying. Here in 2015, a spike, that was a lot of private equity funds buying companies that year. So the PE funds are fickle, and you could take private equity interest in our industry segment to be a sign that the hotter the segment is, the more private equity funds are going to buy, because they do tend to move in herds. They play on trends that they think are going to play out over a couple of years, and so they definitely do that. The strategic buyers tend to be more steady and purchase whenever they can. And frankly, when we're undertaking a transaction with a private equity buyer, there's a lot of hand-holding and there's a lot of explaining the industry, the ups and the downs and so forth. When you're selling a company to a strategic buyer, they just get it, and you don't even need to explain the ups and the downs, and you don't talk about worrying about the forecast and things like that. They'll certainly want to know what the company thinks its forecast will be, but they don't harangue over it like a private equity buyer does, because they're in this industry, they fundamentally understand it, and probably every year that the selling company had a dip, the buyer probably had a dip that year too. So they understand why it happened. You don't need to tell them that. Does that make sense?
Yeah, thank you very much for the clarification.
So much. Yeah, appreciate it. Yeah. Okay. Well, I am going to be sticking around for the coffee break afterward. If anybody has any additional questions, certainly feel free to grab me and share those. And again, thank you very much for having me. Appreciate it. Thanks, Chance.